Hi friends and welcome back to the channel. Software stocks didn't just dip, they got crashed. Atlassian, Monday, ServiceNow, Salesforce, and it doesn't stop there. Workday, DocuSign, Adobe, all down between 40 to 60%. Even the safe names like Intuit and ADP are bleeding out 30% or more. That's not one-week companies as we know. It's an entire sector getting repriced. And this is where the most invested panic. So you see red, you see AI disruption headlines, and you hit the sell button. But let's remember what Warren Buffett once said: be fearful when others are greedy and are greedy when others are fearful. Right now, fear is the only thing software is producing. It looks like it's only thing. So instead of reacting emotionally, let's slow down and ask a better question. Did these businesses collapse? Did revenue fall 50%? Did their customers vanish overnight? Or did valuation simply compress? Those are two very different things. Let's make this simple. If a company earns $20 per share and used to trade at 35 times earnings, that is a $700 per stack. If today it trades at 22 times earnings, that's $440 per stack. Same business, same cash flow, different multiple. That is valuation compression. Now assume earnings grow 15% per year, which despite all the headlines, most of these companies are still doing. In 5 years, that $20 becomes roughly $40. So the real question isn't why it is down, but what we are paying today for future cash flow. And as Benjamin Graham said, in the short run, the market is a voting machine. In the long run, it is a waiting machine. So right now, the market is voting. But our job is to wait, I think. Let's look at the actual weight of these companies here in 2026. This ServiceNow, the bears say AI will replace their workflow tools. But look at the numbers. Subscription revenue is still growing at 21%. The free cash flow margins are at a massive 31%. They just authorized a $5 billion buyback. That is not the behavior of a dying company, isn't it? Look at Intuit. The market is pricing them like a legacy dinosaur. Yet QuickBooks Online is up 23%. Whether AI does your taxes or a human does, they use Intuit's rails. At a 70 PE, you are paying 2014 prices for 2026 dominance. And then there is a Salesforce. The narrative is that agents will replace seats, but Salesforce own agent force revenue just surged nearly 170%, and they are not being replaced. They're becoming the platform that hosts the AI workers. Let's be fair. The bear case is the price per seat model is dying. If an AI can do the work of 10 people, companies buy fewer logins. This is real risk. But the bull case, the one the mass supports, is that these companies are pivoting to consumption revenue. They are not selling logins anymore, they are selling work units. An enterprise isn't going to hand its customer data to a random AI startup. They're going to use the platforms they already trust. The moat isn't the software, the moat is the data gravity. So the voting is over, or is nearly over. All big fortunes made like this, isn't it? The panic has been priced in. When you weigh 20% growth against 50% price cuts, the math stops being scary and starts being an opportunity. You don't buy when the sun is out and everyone is cheering. You buy when the clouds are so dark that no one else can see the path. The market is currently voting for fear, but we're choosing to wait the cash. I've built a SaaS valuation tracker that shows the exact buy levels for the top 15 companies we discussed today. If you want the data behind the noise, comment below and I'll send the link directly into your inbox. Let's run the numbers. Don't